Where to learn more about stochastic volatility. If you are curious about where to learn more about stochastic volatility, especially in the context of stock trading and options, you are in for an informative journey. Stochastic volatility is a fascinating concept that suggests the volatility of an asset's price is not fixed but changes randomly over time. This is a departure from traditional models like the Black-Scholes model, which assumes constant volatility. To get started, it is essential to understand the basic definition and purpose of stochastic volatility models. These models capture the random fluctuations in volatility, helping to explain market phenomena such as the volatility smile and skew in options pricing. They provide a more realistic framework for pricing derivatives compared to constant volatility models. Next, you might want to explore the mathematical foundations behind these models. In stochastic volatility models, both the asset price and its variance, which is volatility squared, follow stochastic processes. Important parameters to consider include the volatility of volatility, which indicates how much volatility itself varies, and the correlation between asset, returns, and volatility changes. For instance, a common observation in stock markets is that when prices fall, volatility tends to rise, which affects option prices in an asymmetrical way. When it comes to popular models, the Heston model is one of the most studied stochastic volatility models used for option pricing. This model incorporates mean reverting volatility and the correlation between asset, returns, and volatility changes. Other models worth looking into include the SABR model and GARCH-type models, which are useful in both pricing and analyzing time series of volatility. For practical applications, understanding stochastic volatility is vital for traders and risk managers dealing with options and other derivatives. It aids in better pricing of options, especially those that are from the money, and helps manage risks related to sudden market movements. While models that incorporate stochastic volatility can be more complex, they provide more accurate estimates of option prices and risk measures. To deepen your knowledge about stochastic volatility, consider several resources. Academic papers and textbooks on mathematical finance often cover stochastic processes and volatility modeling in detail. You can also explore resources that focus on option pricing theory, which includes thorough explanations of the Heston model and SABR model. Additionally, quantitative finance platforms or courses can provide practical implementations and simulations of stochastic volatility models. Reviewing market data and implied volatility surfaces can also help you see how these models explain real-world option pricing patterns. By starting with the fundamental concept of volatility as a random process and moving towards the specifics of stochastic volatility models, you can significantly improve your understanding and application of volatility analysis in stock trading and options strategies.